So there are a couple of things going on, and you had several clips earlier on that talked about, half of the investors think the economy is too strong and that's going to lead to inflation and that's going to lead to higher rates. And then the other half are saying, no, the economy is weak and trade wars might tip it down and we should worry. So these two camps have always been struggling, and last night they both figured out that both of these scenarios are actually negative for stocks. So they all started selling stocks. And what you saw in the U.S. at least was a pretty orderly flight to safety. Stocks went down, bonds went up, the yen went up, the gold went up, the Swiss franc, so the traditional safe haven went up. What went down was what previously led the market up, so the IT sector, growth stocks, momentum stocks, and then they started shifting that money into some of the high dividend yield stocks and sectors like utilities and some of the value stocks and things like that. So everything we saw last night, at least in the U.S. market, is explainable in terms of factor rotation, given what's happening. But remember that yesterday is the last day where macro news really dominates the market. From tonight onwards, we have the Q3 earnings season that starts, and investors want to hear from CEOs. They want to hear whether everything that they fear is showing an impact on their future projections. We heard earlier Christine Lagarde say that some of the investment has already been curtailed. People want to hear from CEOs if that's true or not, and that's going to dictate where we go from there.
Okay, well, on that point then, if we do start to hear those comments coming out of CEOs on Wall Street, could that be the catalyst for the market then to take another leg down or enter a broader correction? What do you think?
So there are different markets, right? So you have emerging markets, you have Asian markets, you have European markets, and they have different sensitivities. So one of the things that we do is we do stress tests on a number of risk factors on an ongoing basis. And what we noticed for Asia and Asian and emerging markets in particular, as of the end of September, the two biggest risk factors was a fall in the U.S. market and a rise in the U.S. dollar. So they weren't so much worried about economic growth or decline. They weren't so much worried about Brexit. They weren't so much worried about the Italian government thing. There was no contagion from that. But the stress test showed a potential large contagion from a fall in the U.S. market and a rise in the U.S. dollar. And that's what we saw today.
Olivier, how are we going to play this? Because this is a point where investors have to be discriminating, don't they? Particularly when it comes to emerging market assets.
Absolutely, yes. I mean, for a while now, they have been discriminating. So they have been looking at, Brazil and Turkey and Pakistan and South Africa, even with a certain wary eye. Meanwhile, they look at some of the Asian emerging markets that are on more stable parts of the supply chain, global supply chains. They're looking at them, okay, the trade war might affect them later, but it hasn't yet, so they kept their bets in place there. But again, if worries do come from CEOs in the next couple of weeks about plans to cut back on investments, they'll start to worry about that bit as well.
And focusing a little bit more on the China-U.S. trade front, I mean, certainly what we've heard from President Trump, no backing down there in terms of the rhetoric. And certainly even as we head into the midterms, he doesn't seem to be backing off. He's using that on the campaign trail for the Republicans, at least, that he's trying to support out there. But in terms of how that's playing at home in China, I mean, this is a situation where you said it yourself, that basically Xi Jinping is really going to be pressured as to what to do next, because he really needs these trade fears and these trade tensions to go away.
Absolutely. I mean, he already had a tough, task ahead with rebalancing the economy away from capital investments and more towards consumerism and services. You throw the trade war into that, and it becomes an impossible task. So, so far the Chinese people have been on his side. Yes, we want you to stand up to the West. Yes, we want you to end the century of shame and all that. But really, they do that when they have money in their pockets. If money starts to flow out of their pockets, they'll start saying, make a deal and make it now. So he might get some pressure ultimately when that happens. But what we saw from a risk point of view is that risk has been rising in China since the trade war started, while it's been going down in the U.S. Over time. So investors have already reacted to that, and they've already placed their bets. And now China is just left on its own, and it's going to have to make a decision. Make a deal or keep going.